So, greetings to everybody. This is Michael, and this is my second lecture on investment appraisal, financial management, and it entails the tax allowable depreciation and inflation. That's the raw and the nominal cost of capital. So, this is a question from the Kaplan, which is Ping School, March June 2019, a sample examination question. So, this will be my final lecture on investment appraisal. So my next lecture will be on the EAC and the replacement cycle, which is very simple. That is borrow and buy. Yeah. So we have Pinsco, which is a large company listed on a major stock exchange. But in recent years, the board of directors or the board of Pinsco have been criticized for weak corporate governance, and two of the company's non-executive directors have just resigned. So this you read up to here. So our focus is on figures. This will come as written part, so you have to identify the corporate governance weakness and just explain it to the examiner. So we have Pin School is appraising an investment project which it hopes will boost its performance. The project will cost $20 million. So that's the initial outlay. The question says a project will cost $20 million, payable in full at the start of the first year of operation. Please do not put the $20 million at year one. Please, it is very wrong. It is the initial outlay. That is the cost of the project. But it will be paid in the first year of operation. Doesn't mean that it is a year one figure. No, it is a year zero figure, which will be a negative figure. So we have a negative 20 million. Mind you, we have three zeros up here, which is acceptable in the exam. So you have to ignore the remaining three zeros. So here you have your 20,000. You have your 20,000. That's all. Let me do so for everywhere. That's your initial outlay. Now the question says that forecast sales volumes, selling price, variable cost, and fixed cost are as follows. So we have the year, that's year one, year two, year three, year four. So the project is having an expected life of 4 years. And here are the values. There are three zeros up here. So here are the sales values. So it is easy. We have the unit here and we have the selling price per unit. So you just multiply the unit. So equal to, that's Excel. So the unit multiplying the rate, which is the selling price per unit, which is 125. This is your figure, 37,500,000. But it is a wrong figure because you are not done reading the question. When you follow the question says that selling price and cost information are in current price terms, meaning that these are in current price terms. It hasn't been adjusted for inflation. So the question says that before applying selling price, inflation of 5% per year, variable cost inflation of 3.5% per year, and fixed cost inflation of 6% per year. So you have to inflate these figures. Instead of multiplying the 3 million by the $125 per unit, which is a wrong figure because it is in current year. So you have to inflate it per year. And as I said earlier, when I have already set up the format because of time, so you just go below to your workings. So here is your workings. You bring the years here, and you bring the sales quantity also here. So the sales quantity from the question, it is 3 million. So 3 million. The next one is 4,100,000. Let me just copy and paste. Okay, so 4,100,000, and the next one is 5,250,000. We also have 2,200,000. But we can take off the 3 zeros. So let's say we have, let's do it in millions. Let's do it in millions. And now we have the sales price. The sales price from the question. Here is the sales price: 125, 130, 140, and 120. So let me copy it and come and paste them here. Okay, and we have the inflation. That's the inflationary figure. The question says that selling price. We say that before applying selling price inflation of 5%. So the selling price inflation is 5%. So you bring your 5% here, 5% over here. Now you look for our inflated selling price, which will be the figure that will come at the sales revenue side in the workings. So inflating the selling price will be equal to the sales quantity multiplying, we bring the multiplication sign, multiplying, because in ACCA you have to show every sign. So multiplying 1 plus the inflationary figure, which is 5%, bracket close, exponent the number of years, which is this year 1. That is your figure. But we have to lock the 5% so that the as the formula is repeating, you can still get the 5% inflation figure, because in this case I haven't logged the 5%. So when I press enter, it gives me this figure. So when I drag it, it will repeat the figure, it will repeat the formula. But you see here it is wrong. Why? Because it didn't use the 5% over here, because it used the formula we used before, meaning that it will take these cells without taking the previous one. So instead we lock the cell, so equal to the sales quantity multiplying 1 plus the inflation figure, which is 5%. So locking it, you bring a dollar sign before the B, a dollar sign before the B, and a dollar sign after the B. You close your bracket, then exponent the number of years, which is 1. So when you drag it, I'm going to get the actual figures. Or better still, if you don't know how to lock it, you just, as after bringing your 5% here, you just repeat all the 5% here, 5% here. Then you do your equal to the sales quantity multiplying, bracket open, 1 plus the inflation figure, 5%, bracket close, exponent the number of years, 1. Then you just drag it all over. Just drag it all over. It will just repeat the format. So these are now your inflated selling price, which will now come here as your sales revenue. So you just have to copy it. Here in ACCA you can copy. So you copy it and you paste it at the sales revenue starting from year 1. You paste it there starting from year 1. Starting from year 1, not year 0. Year 0 is for the initial outlay, and the working capital. So we have inflated the selling price to get our sales revenue adjusted for inflation. Now, when you continue to read the question says that variable cost inflation of 3.5%. So variable cost is also inflated at 3.5%. So we use the same quantity. So but the variable cost per unit was $71. The variable cost per unit. So you bring the variable cost per unit, which is $71. $71 from year 1 up to year 4. Then we have your inflation figure, which is 3.5%. Yeah, if you cannot lock it, you just have to drag it so that it repeats the same percentage. Now the inflated variable cost is equal to the sales quantity multiplying bracket open 1 plus the inflation figure 3.5% bracket close exponent the number of years, which is 1. You press enter, you get your variable cost, which has been adjusted for inflation. You drag it to the year 4. This is your figure. You copy it and you bring it inside your workings. But when you bring it inside your workings, don't bring it here as a positive figure. It's supposed to be a negative figure. So you have to negate what you had here. You have to negate it. You have to negate it and drag it so that everything is negated. So when you come here, or you can copy it, you copy it and you paste it here. You just paste it here. That's all. So when you less it, you get your contribution. So you have sum the two. You close the bracket, you press enter. You just drag it. That's all. You have gotten your contribution. Now we move to the first cost. You have to get your contribution before you less your first cost. Now the first cost, the question is saying that first cost inflation is also 6% per year. But the first cost from the question, this is the first cost. So you just copy it. You just copy it and place it here. You just copy it and paste it here. That's the first cost. And the first cost has nothing to do with the unit. First cost is incurred outside the volume. Remember that first cost is incurred outside the volume. So here is the inflation. The inflation of the first cost is 6%. So 6%, you just drag it to repeat the 6%. Now, so the figure is equal to the 3000 multiplying bracket open 1 plus the 6% bracket close exponent the number of years. So you drag it and this is your figure. You just copy it, but it's supposed to be negative, so you have to negate it. When you drag it for the negative figures, we copy them and we paste it here. So after lesson, so this is your contribution. Then you less your first cost from your contribution to get your taxable cash flow. This is your taxable cash flow. So this the rate, this is the figure you are going to apply the tax on. I'm going to apply the tax on. By reading the question says that pays corporation tax of 26%. So the tax 26%. So the 26% is going to be on the taxable cash flow. So equal to this one multiplying the 26%. This one, or better still, you can just do it equal to this one multiplying 26%. 26%. So this is your taxation. You just drag it and it's going to repeat the formula. So this one is also multiplying 26%. This one is also multiplying 26%. That's all. But mind you, taxation is a negative figure. So you less the taxation, then you drag it to repeat the formula. Now we have tax savings on tax allowable depreciation. That one is also a problem for students, but I will make it simple for you. The question says that the company can claim tax allowable depreciation on the full initial investment of $20 million on a 25% reducing balance basis. On a 25% reducing balance basis. So that's so simple. So you set up your workings. I've already set up the workings. So you have to know the format. So these are your how to calculate for the inflation and everything. So when it comes to the tax allowable depreciation, the reducing balance rate per the question is 25%. So you bring the rate here, reducing balance rate, which is 25% for all of the years. For all of the years. If you have done financial reporting, it's just simple depreciation using the reducing balance method. You also have the tax allowable depreciation. You also have the straight line method. It's the same thing as finding for the depreciation using the straight line method. It's the same thing as depreciation. The same thing. So if you know how to calculate for depreciation using the reducing balance, then this one is also going to be easy for you. So you have your reducing balance rate, which is 25% for all the years. So the asset balance in the first year, the asset balance is going to be 20 million. In the first year, we have 20 million. We have 20 million. So let us erase 3 zeros. So we have 20,000. Now we apply the rate. That will be the tax allowable depreciation. So you apply the rate on the asset balance. So equal to the 20,000 multiplying the 25%. That is 5,000. Then you drag it to your 3. Don't worry, it is 0. Yeah, I know. Now you come here, reducing balance. So you just subtract this from the asset balance. So it is going to be equal to the 20,000 minus the 5,000. Are you getting me? So you drag it to the year 4, and that's your figure for the tax allowable depreciation. So in the case whereby there's a scrap, you bring the scrap value here, and now you less it. But in this case, the question says that the investment project is expected to have zero residual value. So meaning there's no scrap over here. Meaning there's no scrap value over here. So then this figure is what comes down here. That's all. Let me go over again. The tax allowable depreciation is the same as the reducing balance using depreciation. So this 20,000, which is the initial investment, you just multiply it by the rate they gave you, the reducing balance rate. So there's 20,000 multiplying the 25% reducing balance rate. Then you drag it to year 3, not year 4, year 3. Now reducing balance, you just less the asset balance from the depreciation figure. So the asset balance as at year 1 is 20,000. Subtracting the depreciation figure of 5,000 will give you the asset balance in year 2, which is 15,000. Then we drag it to year 4, which is 84,000, which is 8,437.5. So now this figure upwards becomes the figure downwards. So this is the reducing balance depreciation figure. But this is not what will go into your answer. Now, after getting this figure, you apply the tax rate on this figure. So from the question, the tax rate is 26%. So you come here equal to the TAD multiplying 26%. You drag it to the year 4, and these are the figures that will find its way in your answer. So it is a tax saving, so it has to be a positive figure. It has to be a positive figure. It is a tax saving. So after that, you add all of them. You add all of them. So from the taxable cash flow, lessen the taxation and adding the tax savings. Bracket close. So this is your after tax cash flow. Your after tax cash flow. So per the question says that the investment project is expected to have zero residual value at the end of the 4 years. So at the end of the 4 years, the residual value is 0. There was no information about working capital investment, which will also be 0 and 0. But in the case where there is a working capital investment, it becomes a negative figure in year 0 and a positive figure at the end of the useful life. So now we have our net cash flow. So our net cash flow here, the only figure here is our 20,000, which is our initial investment. So now our net cash flow is the sum of our after tax cash flow, our residual value, and our working capital investment. You close the bracket, you add, then you drag it all the way here to year 4. So this is your net cash flow. Now you have to find your present value. The question says that calculate the nominal net present value. The nominal net present value. And here they give you a nominal after tax cost of capital, which is 12%. So we are going to use a rate of 12%. Are you getting me? We are going to use a rate of 12%. So we have to calculate for the present value figures. But in the determination, we have the tables there, the formula tables. So you can just quickly go and find the present value figures. But if there's time, but if there is no time, you have to find your present value figures. And finding the present value figures in Excel is easy. So this is how you find the present value figures. You bring your equal to sign. So your equal to, then your 1, don't forget your 1 plus the percentage, which is 12%, 12%, bracket close, exponent, negative the number of years. So exponent here, the year is 0. You press your enter. It's going to give you 1, because every number exponent 0 is going to give you 1. So the present value, or the let's say, okay, let's use discount factor, so that you understand your discount factor. So this is the discount factor. Now you drag the formula to year 4 to get a discount factor for this years to 2 decimal places, or let's make it 4. Let's make it 4 decimal places. Now we have our present values, which is PV. So equal to the discount factor multiplying the net cash flow. You just drag them. That's all. So that's your present values. That's your present value figure. Now we use your nominal NPV. Your nominal NPV. So the nominal NPV is going to be the sum of everything here. So equal to sum, start from year 0 up to the last year, include the bracket. So this is your NPV, 286,862.99. That's your net present value using the nominal approach. That is it. So you have done the inflation and the tax allowable depreciation. The question says that A, calculate the nominal net present value. So you use the nominal after tax cost of capital. So very simple. And now the II says that calculate the real net present value of principal. I've already set up the formula or the format. So you just go to what you did and do not shiver. In the exam, even if you are wrong, use the same formula. They are going to mark it for you. We have something called the own figure rule. So you use the non-taxable cash flow. The nominal taxable cash flow. The nominal taxable cash flow. The nominal taxable cash flow before the tax savings and the tax. So here is the nominal taxable cash flow. You just copy it and bring it here. That's the taxable cash flow. Now you adjust for the real inflation. The real inflation. So here you now have the real taxable cash flow, and here you use the general rate of inflation. This is the nominal after tax cost of capital, which is 12%. And this is the roll after tax cost of capital. So this roll after tax cost of capital is what we use for the present value figures. But the general rate of inflation, which is 3.7, is what we will use to inflate the 41,820. So here to be equal to the figure here upward divided by bracket open 1 plus the figure, which is 3.7%, 3.7% bracket close exponent the number of years, which is 1. Then you have to bring your bracket here. Enter. You bracket. That's all. So this is a real taxable cash flow. Then you apply your tax rate. This multiplying the tax rate, which is 26%. 26%, which is a negative figure. Just drag it here. That's all. Now your tax savings on your tax allowable depreciation, you bring the same figures you had here. The same figures you had here. You bring them, you copy them and bring them below. Copy them and bring them below. Now we have your after tax cash flow. Your after tax cash flow equal to sum this and this. You close your bracket. So your raw taxable cash flow less your taxation and your tax savings. You just drag it to the year 4. You have your initial investment, which is 20,000. Now we have our net raw cash flow. Now your present value figures. Now we are going to use the raw after tax cost of capital, which is 8%. So your present value figures, it is going to be equal to the cash flow multiplying, let's ignore the initial investment, so equal to your cash flow multiplying bracket open 1 plus the percentage, which is 8%, 8% bracket close exponent negative the number of years, which is 1. Press enter. So you drag it again. So here's your negative 20,000. So your raw net present value is going to be the sum of everything here. So this is your raw net present value and this is your nominal net present value. So that's all you need to know about inflation, and your tax allowable depreciation, right? Yeah, the figures are similar to the Kaplan answers because because of the decimals. You see, there are some I ignored the decimals, and there are some I added the decimals. Are you getting me? But in the exams, you can leave the decimals. Don't touch the decimals. You can just leave it like that. They are still going to mark it for you. But because I want to make things simple for you, that's why I ignored the decimals. So you can look at the format, and you can also look at the workings for the inflation and the tax allowable depreciation. So this is a pre-school March June 2019, an examinable question. So my next lecture will be on EAC and also replacement cycle, and whether you should borrow or you should buy. Yeah, lease or buy. I also touch on them. They are very simple, and then I will end the session on investment appraisal. And now my next lecture will be on cost of capital, how to find a weighted average cost of capital, and they are very simple. I will touch on them. And if you also need lectures on financial reporting, I am also available. You can contact me, but please do not forget to subscribe. Thank you very much.